And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. It is, of course, Tuesday, technically speaking Tuesday, of course, and that article will be on our website here very shortly. Talking about interest rates, and of course, the issue now, of course, is interest rates have been rising here lately. What does that mean for the markets? That's all in our Technically Speaking post today on the website at realinvestmentadvice.com. But speaking of Technically Speaking and markets and everything's going on yesterday, quite the sell-off. Surprised a lot of people. Market was down roughly at one point, almost 900 points on the Dow. Did recover a little bit right at the end of the day, finishing down about 600 points or so, but still a fairly sharp sell-off for markets, about 2.2, a little over 2% for the S&P yesterday. We've been talking about this decline here over the last couple of weeks. We've been slowly kind of grinding lower here in the markets as really this has been a concern about no stimulus. And, you know, this whole idea was one day to the next, hey, we're going to get stimulus. Well, maybe not. Next day, we're going to get stimulus. Well, maybe not. Of course, every talking head up in Washington, D.C. was coming out. I was like, yep, stimulus is coming. And the markets would rally on that and then sell off when they realized that no stimulus is coming. Ladies and gentlemen, no stimulus is coming, right? It's not coming. And it's going to be after January, most likely, before we see stimulus being done, which suggests that this next couple of months in the economy are going to be pretty tough going here as we begin to see more of discretionary incomes being pulled back, consumer spending pulling back, etc. So again, paying attention to that. Now, the good news yesterday is that the market did hold on right to the 50-day moving average support here. So again, the market hasn't done anything wrong at this point. And even yesterday's decline, while fairly sharp, was really not outside of the realm of ordinary, right? It was a big sell-off day, no doubt about that. But again, well within the context of this downtrend that we've been building here now for the last couple months. We had hit the top of that downtrend on Friday, hit the lower bound of that downtrend yesterday. We're going to bounce a little bit today and see what the markets can do with it as we kind of continue to wind up this week. Lots of earnings announcement this week. Big news. Semiconductors are just eating themselves up, right? NVIDIA made an acquisition. Now AMD is buying Xilinx. And again, we're just getting a lot of consolidation in the semiconductor space. So that's going to be moving semiconductor stocks higher this morning. But again, overall, the market's doing okay. We're in the midst of earnings week right now. Lots of big corporate earnings coming out. So there's going to be some natural support for the market as we get some better than expected numbers. And yes, we have about 85% of companies beating estimates right now. Not surprising after you lower the estimates low enough. Hey, you're going to get some beats here, right? So we're getting the beats, and that's going to help lift stock prices, give a little bit of support here to the market short term. Again, if you've got concerns in your portfolio, right, if things aren't working the way you thought, use these opportunities, these bounce to lighten up a little bit of risk. We're clearly in a downtrend right now. There's clearly negative pressure to markets. That continues to be the case with our money flow sell signal that remains intact right now. Now, importantly, though, that sell signal is getting back towards its lows. So this is, again, where we begin to see the market begin to stabilize here and begin to see some turn. And I would suspect that after the election, and this is suggesting that we get kind of a normal election, not a contested one, but after the election, we're going to start to see money flows kind of come back in. Once things kind of settle down and everybody kind of knows what's going on, who's elected, who owns the Senate, etc., we'll start to see some money flows coming back to the markets. That'll start to flatten this out, turn it back positive. And typically, statistically speaking, through the end of the year, markets tend to perform well after the election is accomplished. Again, the big risk over the next really couple of weeks is going to be a contested election. We have, we're going to be approaching 100 million mail-in ballots, right? We're just shattering records on the number of people mailing in ballots. There's going to be lots of potential contests, lawsuits, arguments. There's a big risk. We may not know who the president is here for several weeks as we kind of sort this mess out. But this is just going to be one of the things that we have to deal with this year. And again, that does provide risk here. And again, I don't want to, be remiss in not suggesting that there is downside risk back to the 200-day moving average in a contested election. Again, would certainly provide the catalyst for that downside. Now, the good news is that more and more people are becoming aware of this idea, right? So the more people that know about it, the market tends to price that in, so that downside risk is becoming less and less as we get closer to the election. But again, it's still worth paying attention to the fact that we do have that risk down to support between the September lows and the 200-day moving average. So again, pay attention to that. That's going to be something, at least in the near term, is a risk to market. So again, this is why we've been talking about raising cash here recently, being a little bit more optimistic. Okay, now, as we kind of get into the day, of course, Amy Coney Barrett last night confirmed by the Senate to the Supreme Court. So that sent the Democrats into a left-handed tizzy yesterday. So, this is going to be one of those payback deals once we get into a new presidential cycle. So, again, watch out for this is coming. But that's really good news, of course, that I think she's going to be a fine justice and she's going to do a great job. But that's going to be a lot of the headline talk today that you're going to get. The other big kind of headline numbers we're going to get out today, and again, as we move in towards Friday. Now, Friday's the big day. What's on Friday? That's GDP day, right? On Friday, we're going to get the first estimate of third quarter GDP. Now, here's the exciting part of that. It's going to be a 35% increase in GDP growth. Now, right, that's going to be one of the largest jumps in GDP in the history of tracking GDP growth. Here's the not so good news. We're still being in a recession. Now, I know this is kind of hard. This is that funky math thing that goes on. But when you start talking about percentages, we had a greater than 30% decline back in March when we in June when we reported second quarter GDP. So if we have a 30% decline and a 35% advance, we don't get back to even, right? And so the economy will still be in a recession. In fact, we'll still be in one of the deepest recessions in the history of the U.S. on an annualized basis. So this is going to be very hard for people to grasp. How can you have this big, massive jump in GDP, still be in a recession? It's because of the way percentages work and how we measure GDP. But the important thing is markets will likely respond positively to that big pop in GDP if it comes in where estimates are currently expecting. And I think they will. Retail sales have been good. If you take a look at a lot of the economic and manufacturing data, that's been improving markedly. So there's a real expectation that we'll see right around between 30-35% pop in GDP on Friday. That's going to be kind of a lift for markets as well, help provide some of that support, at least in the near term, to help support prices. But the big thing, again, go to our website today, realinvestmentadvice.com. I'll be on the break here. I will post the Technically Speaking post. But it's all about interest rates and bonds and why we reduced bonds recently and why we are looking to be heavy bond buyers in the not too distant future. But we go through all the stats and details on that in the news, in the Technically Speaking post today. It's on the website, realinvestmentadvice.com. We'll be right back.
Got questions for Lance later? Ask now at realinvestmentadvice.com.
With the last ballot tallied, what will America's legacy be? What does the future hold for your retirement, your family, for you beyond the election? Richard Rosso and Danny Ratliff's next Candid Coffee will specifically address your questions about money, retirement, risk management, and how to protect your household against financial vulnerability, regardless of who's in charge. Send your questions and join this post-election go-to webinar at realinvestmentadvice.com. Candid Coffee with Ratliff and Rosso at realinvestmentadvice.com.
Green shirt, new shoes, and I don't know where I'm going to.
And welcome back to the show this morning. I'm your host, Lance Roberts. Of course, as we kind of get this Tuesday underway, Again, as I was saying a second ago, lots of companies out reporting earnings today. AMD, Eli Lilly, a whole variety of others. And again, this is just a real kind of an inundation week of earnings. So lots of market volatility going on because of hits and misses, right? So, for instance, Eli Lilly came in this morning, missed their estimates on revenues. They came in at $5.74 billion versus $5.88. So the stock's down roughly about 4%. And again, this has been kind of an interesting earnings season because companies that are beating earnings are being well rewarded, and ones that miss are being crushed. So, there's not a lot of forgiveness in the market currently. And a lot of this has to do with the fact that there's really a very big lack of liquidity in markets. And, when you've got a lot of, and this is a byproduct of this whole passive investing thing that goes on. We've got more ETFs out there that are buying individual stocks, and the belief has long been that these provide liquidity. And actually what we've been finding out is that it's extracting liquidity from the market, and that's why markets have been so much more volatile over the course of the last several years. And as the ETF kind of passive investing thing continues to move forward, that lack of liquidity continues to be a bigger and bigger problem. And this is just why you see stocks moving in such large ranges, in 1 day, 2 day periods. So again, it's just, something new that we're going to have to live with as we go on. And as we continue to kind of evolve in the markets, just get used to more volatility, right? Just going to be a little bit more active about how you manage risk and how you manage volatility. One of the interesting things that's happening this earnings season too is that we've got a lot of companies withholding guidance, right? So they're not even telling you what they expect for the next quarter. It's like, here's our earnings. Thank you very much. Come back next quarter. Normally what they do is they say, hey, here's how we've done, and this is what we expect next quarter. Here's we expect to do, $2 billion in sales and, $4 billion in earnings, whatever it is. And the analysts work off those estimates. Well, a lot of companies, because of the coronavirus, what's going on, they're withholding that guidance. They're just reporting earnings and saying, hey, kind of on your own in terms of analysts. So analysts are kind of scrambling to try to figure out, how to create earnings, right? And how to make some estimates based off what they have. And as I talked about in today's post, if you go to our website again and read our post today on our Technically Speaking, in just the last 15 days, now this is going to be for the fourth quarter earnings, right? But we have these reports, and we've talked about this before on the show. We call it Millennial Soccer. But we have these reports of companies, and they come in with their estimates, and they say, okay, we earned $1 a share, and it beat estimates by a penny. And so everybody gets all excited. And we have these reports coming out from, brokerage firms and other places like 85% of companies are beating estimates. Well, of course, right? You lower estimates enough, everybody's going to beat them. And that's what's happening. Just in the last 15 days, the 2021 estimates, right? We talked a little bit about this yesterday, but I have a chart on it this morning, and Technically Speaking, over the last 15 days, the estimates for 2021 have fallen to $135 a share, down from $142. So almost a $7 decline in just 15 days. And you go, okay, well, Lance, that's fine. Well, the problem is that in January of this year, this is October. In January of this year, 2021 estimates were at $171 a share. Now they're at $135. So when we eventually get to 2021 and actually can get to the fourth quarter of 2021, we'll be probably around $120 a share. And companies will beat those earnings and we'll be all excited. Yay. But one of the long-standing problems in this market in particular is really twofold. One is that we should hold analysts accountable for their estimates, right? Hey, you said at the beginning of the quarter that Apple was going to earn X. And you have to stay by that, right? Analysts aren't any good at their job. This is like being a fortune teller. And you go to the fortune teller on Monday and they say, you're going to be very rich by the end of the week. Go back on Tuesday, it's like, you're going to be a little bit rich by the end of the week. Wednesday, you might not be so rich. Thursday, they say, nothing's really going to change. Friday, nothing happens. You go back and the fortune teller says, see, I told you. Nothing was going to change. That's what this is, right? If we really want to know, and what kills me, this is the thing that kills me, is like every year they come out with these reports, is like, Mike Johnson was the #1 all-star analyst for the best predictions of estimates. No, you weren't. You were just the one that got closest on revising down your estimates, right? If we held analysts to their estimates, we'd find out how good they actually were, right? And if we actually would hold analysts to their estimates, they would also be much more pragmatic about how they estimate earnings, and we get a much better data source to work off of. But, when you're just constantly ratcheting down earnings so that companies can beat them. And this doesn't happen just this year. This every year. Every single year, if you go back and look at earnings estimates going back to 1970, 1980, right? Every single year, analyst estimates start out about 33% too high, right? And they've got to be ratcheted down. And then companies beat them, we all get excited, right? It's the game. It's the game we play. But, when you look at analyst estimates, they have no value. Analyst estimates have no value because they're not really estimating anything, right? They're just taking a stab at it, and then they keep revising it down as they communicate with the company to make sure that the company can beat them so that it supports stock prices so they get the investment banking business. This is why 90% of companies have buy ratings on them and you have no sell ratings, because Wall Street wants the investment banking business. They don't care about you. They don't care about you buying stock on Robinhood. They get no money out of that, right? They want the investment banking transactions. That's hundreds of millions of dollars. See, they want to do the deals for AMD buying Xilinx, right? They make hundreds of millions of dollars doing that. The other thing, though, is that companies have figured out is how to manipulate the algorithms. So now what happens is when these companies do their earnings guidance and they do their earnings announcements, right? All these algorithms are listening now to the actual recorded announcement. So, Tim Cook gets up there for Apple and he says, hey, this is what we're doing with the iPhone 12, yada, yada, yada. Our earnings are going to be this. Our revenues are going to be that. Well, now the companies have figured out, it's like, hey, I've got all these algos listening to me that are now going to trade stocks based upon what I say. So now these companies' earnings guidances are being written in a manner to trigger the algos to buy the stock, have all the right keywords. So this is where we're getting into in terms of the financial markets, right? Price discovery is dead. It's over with. It's done. This is all about understanding how to play the game. And, this is just going to be, and this is what I'm saying, volatility is now going to be a much bigger part of portfolio management in the future, and dealing with that volatility and trying to play the longer term trends, because that's the environment we're moving into. The more and more electronic that we get, the more and more that we move towards this kind of automated trading, et cetera, more ETFs, more packaged products, et cetera, that all reduces liquidity and price discovery in the markets, creates more volatility. And unfortunately, when things go wrong, as we saw back in March, they go wrong very quickly. And that's just going to be part of the markets that we have to live with because of the way the markets now work. This is a profit and greed game that if you're going to play it, you've got to understand it. This is not the market that I grew up with, where people actually bought and invested in stocks because of earnings and fundamentals and those type of things. Those days are long over. The average holding time for stocks when I first started in this business back in the 80s was about 6 years. Today, the average holding period for a stock is about 3 months. So, if you're the guy sitting there with your portfolio going, hey, I'm buying this stock for the long term, I'm just going to hold on to it, you're the only idiot doing that. Everybody else is trading around you. But that affects price, and that affects liquidity. So, just something to pay attention to. Okay, we'll come back. Enough of that. The article's on the website right now, though, talking about interest rates and why, while bonds are under pressure short term, as interest rates go up on expectations of more stimulus, etc., there's a huge bond buying opportunity coming down the road, and you'll want to be prepared for that. That article's on the website now. Huge bond buying opportunity coming on the website now, realinvestmentadvice.com. Stick around, come back. More coming up on the Real Investment Show. I'm your host, Lance Roberts. Don't go away.
It's always tease. You're happy when I'm on my knees.
Get daily investment news you can use, delivered at the speed of the internet. Sign up for the Real Investment Report now at realinvestmentadvice.com.
With the last ballot tallied, what will America's legacy be? What does the future hold for your retirement, your family, for you beyond the election? Richard Rosso and Danny Ratliff's next Candid Coffee will specifically address your questions about money, retirement, risk management, and how to protect your household against financial vulnerability, regardless of who's in charge. Send your questions and join this post-election go-to webinar at realinvestmentadvice.com. Candid Coffee with Ratliff and Rosso at realinvestmentadvice.com.
Welcome back to the show this morning. I'm Roast Lance Roberts. Well, so yesterday we had a big sell-off. Everybody kind of went, what? One of those days. And it was a little bit bigger than expected. We've been talking about here on the show that the market's been working its way into kind of this downtrend here over the last couple of weeks. And we had talked about, previously when the markets had gotten very overbought, we said, hey, as we move closer to the election, likely to get some weakness, sell-off, very normal, right, for this time of year. And, as the realization that we weren't going to get more stimulus was coming in, we said, hey, there's risk to the downside, right? So all this has kind of played out a lot like we said it was going to. And it's just a function that, the markets have gotten overbought short term, and we were on a money flow sell signal. And so all this has kind of played out precisely as expected. And we talked about when that money flow sell signal triggered, and I actually had this link in our newsletter this past weekend. We said when that money flow sell signal triggered, that it implied that there was downward pressure on prices as long as that signal existed. Well, and that's kind of what's happened. Again, it's all been very orderly, all within a nice downtrend, nothing dramatic. And while yesterday was a 2.2% decline in the S&P and a big day on the Dow, it wasn't outside the realm of ordinary, right? We held support at the 50-day moving average, held support within the downtrend channel. Nothing broke, right? So nothing to worry about. But the question is what caused it? And why was it that industrial stocks in particular got hammered the most? Industrials were down over 3% yesterday, way more than the market. Well, a lot of this has to do with a couple of reasons. One, these stocks have been rallying on a declining U.S. dollar, weaker dollar. And the other reason was that there was a lot of expectation of a blue wave, right? Which means, the Democrats maintain control of the House, Democrats gain control of the Senate, and Joe Biden wins the presidency. So now you got Washington entirely Democrat. And the expectation was there, and again, why there was money kind of flowing into these sectors, industrials, basic materials, et cetera, was this idea of this blue wave would lead to a lot of stimulus, right? So you'd have, direct checks to households. We would do expanded unemployment benefits, and then we would do massive infrastructure programs to convert the entire country from petroleum to clean energy, right? So that was going to be, that's Joe Biden's kind of plan, right? So kind of Wall Street, as always, what Wall Street does is they kind of start placing bets on expectations of what they think might come to be, right? So Wall Street's always trying to guess where we're headed and try to anticipate those things. So one of the things that caused the sell-off yesterday was kind of the declining odds of a blue wave. And as we start to see polls kind of tighten up, and people are starting to realize that there's a risk that Joe Biden might not win, the presidency. I know there's a lot of hope, right? But there's a possibility he doesn't win, and that kind of that realization after a big run up in these stock prices really kind of started sinking in. And again, this is the one thing we always try to explain, like we write in our as we discuss on a weekly basis with our RIA Pro subscribers. We produce a market commentary and a sector commentary on Mondays and Tuesdays. And when you go through those sectors, basic materials, industrials, they've had a huge run. They were extremely overbought. And whenever you get into these positions, and we talk about this often, right, about the stretching of a rubber band as far as you can in one direction, is that when you stretch these things, eventually they have to come back, right? They've got to relax so that they can go up again, right? And what you need is some type of catalyst. And you never know what that catalyst is, right? You never know what it is that's going to trigger the selling. And again, sometimes it can be an unexpected event, such as a pandemic, right? Or it can be the realization that maybe what I was running these stocks up on might not come to pass, which is kind of what we saw yesterday. Now, again, doesn't mean the industrial trade is over. Doesn't mean that Joe Biden won't win the election. Doesn't mean the Senate won't take that, won't go Democrat, right? Doesn't mean any of that. It just means that what the markets decided yesterday was that the risk of a blue wave has risen to the point to where, or I shouldn't say the risk of a blue wave not happening is what I'm trying to say here, rose, and that took some of the impetus to be long those sectors off the table. So there was selling, right? And again, we talked about lack of liquidity in the last segment. This is what happens, right? When people start selling ETFs, that increases the pressure on equities to sell off. And we talked about, and said, well, Lance, you said it was liquidity. And that's right. There's only so many people willing to sell a stock at a certain price. And there's only so many people willing to buy a stock at a certain price. So when you have a lot of pressure off passive indexes, so as people start selling XLI and other industrial ETFs, that increases the selling pressure on the underlying and individual stocks. And as prices fall, buyers step back and go, hey, you know what? I'll wait for it to get a little cheaper. And when there's not a buyer there to buy, if there's not a large group of people willing to buy at a price, that price continues to fall until it finds those buyers. Now, you always hear the statement, for every buyer, there's a seller. And that's absolutely true. You can't have a transaction without two sides of it. And when anybody buys something, they think they're right. When somebody sells something, they think they're right. You only find out after the fact. But as prices begin to fall, buyers become rarer than the sellers. In other words, there's more people wanting to sell at a certain price than people willing to buy, and prices have to find those buyers. So when you have that gap kind of open up, and we saw this yesterday, and particularly in the industrial and material sectors, which underperformed the S&P yesterday, that gap opened up because there wasn't a lot of liquidity ready available. In other words, there weren't buyers standing there ready to buy at any price. They moved back. So prices fell more than expected. But that's the lack of liquidity that we're talking about. And it's being exacerbated, as we said a second ago, by the fact that you've got all this passive investing going on, right? So all these ETFs. So, but back to the story, the hope is that after the election, and this has been the run up in these particular areas, right? Industrials, basic materials, etc. That after the election, there'll be a lot more stimulus, a lot more support in terms of infrastructure spending, these type of things. And really that comes from both parties. While everybody's kind of freaking out that, Trump may win or Biden may win, really what you get at the end of the day is you get the same thing, right? They just have different goals. They have just different ways of going about spending money. Trump wants to do infrastructure as well, just differently than the way Biden wants to do it. Trump is open to doing a big stimulus package. And if he gets reelected, he's going to do a big stimulus package, including checks to households, et cetera, right? He wants to spend money just as much as everybody else does. Now, the debt's another issue, and we've talked about that recently this past Saturday on our webinar. When's that coming out?
Later today.
On the website later today, we'll have our discussion from this past weekend called Policy Over Politics, talking about the debt and the debt trap that we're getting ourselves into. But right now, both candidates want to spend money. So whoever gets elected, they're going to pass infrastructure spending. The only question is going to be, where does that money get spent? Is it going to be on the solar and the green, or is it going to be on petroleum and building roads and bridges, right? So it just depends on who gets elected and where the money gets spent. But from an investment standpoint, we're going to see that money coming in after the election. So the only question now is the timing of that election and when it gets decided and when we can get bills passed to spend more money. That's all coming. And as the Federal Reserve has been saying, they want more stimulus. Why? Because they can't do more QE unless the Treasury issues more debt. So without more deficit spending, the Treasury can't issue more debt and the Fed can't monetize it, which right now, the reason that everybody's kind of on hold is everybody's waiting on more spending, more debt. But, this is where the trade has been, is banking on that kind of idea. And the reason we had the sell-off yesterday is kind of repositioning that may not come, as soon as we expect, and it may not be in the form that we expected. Be right back after the break.
Real Investment Show podcasts are now available on iTunes. Listen anyplace, anytime at iTunes.com.
With the last ballot tallied, what will America's legacy be? What does the future hold for your retirement, your family, for you beyond the election? Richard Rosso and Danny Ratliff's next Candid Coffee will specifically address your questions about money, retirement, risk management, and how to protect your household against financial vulnerability, regardless of who's in charge. Send your questions and join this post-election go-to webinar at realinvestmentadvice.com. Candid Coffee with Ratliff and Rosso at realinvestmentadvice.com.
Let's go!
And welcome back to the show this morning. I'm your host, Clarence Roberts. So, as I said at the opening this morning, on Friday, we'll report GDP, which is going to show probably about a 35% pop in the third quarter. Apologies. And that was following about a more than 30% decline in the second quarter. And as we talked about on the show, recently, fun with math. If you have $100 and you lose, $30, you lost 30%, right? So you got $70 left. If you get 30% of it back on $70, you're at $91, right? You don't get your 100, you don't get back to 100, right? You come back to a lower number. And that's what we're dealing with now in terms of these percentages. We had a big percentage loss off a much bigger number in the second quarter. So now we're going to have this record-shattering gain in the third quarter, but we still be in a recession. Unfortunately, things are getting weaker. Caterpillar this morning, if there's ever a good proxy for the economy, it's Caterpillar, right? They build bulldozers and pavers and, all that stuff, right? You drive down the freeway and those big yellow behemoths.
It's big boy toys.
Yes. All along the road, working, right? So if there's ever a proxy of what's going on economically, it's Caterpillar. Not just domestically, but internationally as well. And so when we hear these stories about, wow, the economy's recovering, we're back on track, man, it's great, we're just hired 11 million people, put them back to work. All true, coming off a shutdown, nobody's working. Now we put some people back to work. So yeah, big numbers. Sustainability is now the question. Caterpillar reported a 54% drop in sales in the third quarter amid lower equipment demand. So again, while we're seeing economic recovery, it's bifurcated at best, right? There's some areas of the economy doing better than others. And going into the fourth quarter, the Chicago Fed National Activity Index. Now, this index does not get a lot of love from the media because it's complicated and they can't put it into a soundbite, so they ignore it. But, it's one of the best indicators of what's happening economically. Why? Because it has 85 different subcomponents that covers everything in the economy from manufacturing to service to sales, the whole nine yards, right? So it's a really good economic indicator, and that indicator is declining fairly rapidly as we head into the fourth quarter. It's all suggesting that, again, we have a bifurcated economy. We have some areas doing well, some areas not doing so well. And again, there's a difference between restarting and recovering. I talked about on the show yesterday, my wife and I went out for dinner on Friday night, and, we're old. We don't like to wait. If the line at Luby's is too long, we go somewhere else. I'm joking.
Well, you're on limited time.
Yeah, well.
The older you get.
Exactly. I don't want to waste time standing in line. I don't have a lot of it left. But, we were driving around going to restaurants, and there's lines outside the restaurants. And so we're like, let's go, we've got a few haunts that we go to on a regular basis. So we just went to a different haunt, right? We're not real picky about food. We'll eat anything. When you're on a diet and you go out for a treat, you'll eat anything.
Yeah, how much can you do with lettuce?
Exactly. So when you go out, it's like, what do you want? You're right. We're gonna blow our diet. We're gonna cheat. It don't matter. It doesn't matter where you eat. If they got a menu and table service, you're all in.
Any port in a storm.
Exactly. Because when you go back home, it's back to the diet. Anyway. So we're going out, and restaurant 1 packed, restaurant 2 packed in line. Finally went to one of our restaurants, and there was still a line, but it was very short and easy to get in. So we stopped and ate there. But you get inside, and of course, it's like, wow, man, parking lot's pretty full. Line outside the door, they must be blowing and going. Get inside, every other table's empty, right? And the point about that is there's a difference between reopening and recovery. We've reopened the economy, so the third quarter GDP is going to show this very sharp gain from reopening. We go from, if your normal table flow at a restaurant or your normal business is 100 customers or $100,000 a day in revenue, however you want to measure your normal business, and you go from 100 to 0, that was the shutdown. Because now you got no customers, right? Nobody can come to your shop because we're shut down. And then we say, okay, now you can reopen. And you go from 0 to 1 customer or 0 to $1, right? You've had a 100% increase in sales, right? So when you see a lot of this economic data, survey points, they say, well, how's your business doing? Man, we're doing great. We're up 100%. Yeah. That's the issue. And so when you look at a lot of these survey data points, they look fantastic, right? And if you take a look at this, you're just like, man, why do we need more stimulus? The economy's doing great. we're blowing and going. I mean, we got record manufacturing numbers right now on sentiment, right? ISM's back up into major expansion territory. Again, problem is that these are surveys based on percentage changes in data, and the data is skewed because of this shutdown. Now, eventually, this is all going to work itself out, right? We'll get back to some normalcy. But again, when we take a look at the economy, is it recovering? Absolutely, it's recovering. It's getting better. Has it recovered? Absolutely not. Because, again, how do you recover if you're at 50% or even 75% capacity? Most businesses operate with a very slim profit margin, 10%, 20% profit margin. So if you're at 75% open, right, if you're only at 75% capacity of your business, you may be breaking even, maybe, because your profit margin is just not there, right? Until you get back to 100% open, it's going to be very hard for you to be profitable, especially when you have a labor-intensive business, right? Employees are expensive. You got payroll, you got taxes, healthcare benefits, 401k plans, all the stuff they want, right? Employees are expensive. So trying to get back to profitability is challenging for a lot of these businesses. And this is why, look, you take a look at the bankruptcy rate in small businesses, sharply on the rise here. We're going to probably wind up losing 40% of our small businesses, maybe more, and they make up about half the employment in the U.S. So, this is no small thing, right? You may look around your neighborhood and go, yeah, there's a nail salon and they went out of business. There was this hair place that went out of business. Those 3 restaurants down the corner, yeah, they didn't make it. They weren't that big. They're very important. The majority of employment, or I shouldn't say the majority, but almost half, let's put it that way, of the employment in the U.S. is done by businesses of 100 or fewer employees. The number of small businesses that have 5 or fewer employees make up a very large chunk of the economy. So, mom and pop on the corner, very important to the economy. Very important to your neighborhood too, right? Those are your neighbors. Always get a tickle when people talk about, they get upset at ExxonMobil or Chevron or somewhere. It's like, hey, let's boycott the gas station at the corner. You're not hurting ExxonMobil. That's your neighbor that owns the ExxonMobil station at the corner, and he depends on the sales of gasoline for his retail sales, which is where his income comes from to live in your neighborhood, right? So when you're boycotting that local convenience store because you're pissed off at ExxonMobil, you're not hurting ExxonMobil. They already sold the gas to the poor guy at the corner, right? They've got their money. You're only hurting your neighbor, all right? Small businesses are your neighbors. That's your neighborhood. That's your economy that you live in your area. This is why it's so important that we support our local businesses, right? It's right now we're all in freak out mode and we're buying everything from Amazon, right? Online orders are shooting through the roof. A lot of those are Amazon. But, we need to take a serious step back and think about our neighborhood. And instead of ordering something at Amazon, go buy it from a local retailer in your neighborhood, because they depend on you, right? Your economy in your neighborhood depends on you. How we live and operate in our areas depend on you. And we forget about, look, it's easy to forget about this, and I forget about it too. Look, I'm just as guilty as everybody else, right? I'm in a hurry, I need something, order it from Amazon. But, we really need to step back and think about these things, because our local areas are very important. This is the one thing that people don't understand about communities. You take a look at the Jewish community, the Asian community, et cetera. They live together. They shop their own businesses. They support their own structure, right? And that's why these areas tend to be very well. They tend to economically do very well most of the time because they all support each other. And we need to take that model and we need to adapt that now, because
If we lose half of our small businesses, the economy will never get back to where it was pre-pandemic. That's just how important Jim and his restaurant is down the corner, and Sarah and the hair salon down on the street corner, the dry cleaners on the other corner. Those are very important to the overall economy. And we need to seriously think about next time before we click that Amazon button, could we get it from a local supplier? Could we support our local retailers? Could we support our community? See you next time on the next edition of The Real Investment Show. Get by the website today. We have a new article out talking about why there's a huge bond buying opportunity. Not today, coming. A huge bond buying opportunity that'll make you a lot of money. That's on the website now, at the website, realinvestmentadvice.com. Send your questions, comments, and emails, and get our link to our Policy Over Politics webinar coming up today. That'll be out there, realinvestmentadvice.com. See you next time.